Many young American investors are asking if stocks are really the safest bet, and they're looking for more stable alternatives. Liling reports.
New York resident Min Wei Ding holds stocks in Berkshire Hathaway and JP Morgan Chase, which recently lost several billions of dollars in risky trades. That experience, along with the weak U.S. recovery and Europe's debt crisis, is making him question the prudence of his investment strategy.
So I'd be a little wary about getting into equities. On the other hand, interest rates are so low that there aren't really many options.
He's not alone. Some financial planners say young investors are moving out of equities or stocks and into more stable investments like real estate and bonds. And the trend is likely to continue for another 2 years, according to New York-based financial planning firm Rudman Cannon, as young investors continue to lose confidence in a market that may have seen more volatility than they can stomach. It's a headache for asset managers. According to a report from the Boston Consulting Group, growth in the $58 trillion global asset management industry has stalled. However, investment strategist Vinny Catalano says while many investors are moving out of direct ownership of stocks, they are still in stocks through mutual funds and exchange-traded funds, or ETFs.
The issue about individual investors moving out of individual investments, individual stocks, and more towards ETFs and mutual funds all fits within the context of the uncertainty that we're facing in the world and that they face in terms of an economic environment that is hard to understand.
His advice to young investors: a diversified portfolio is still the safest. You can reduce the risk of owning stocks by investing in ETFs, mutual funds, and a smaller selection of individual stocks. Liling, CCTV, New York.